Yes.
Actually, the recordings will be in the YouTube, right?
Yeah. Pardon?
The recordings will be uploaded in the YouTube.
Uh, let's see if I can. But if not, I will take the recording from Google Drive, and then I will share directly in the group, and then you can download it and have a look. Yeah. Let's see.
But in the group don't have, sir. In the YouTube
Oh, you
also.
don't have. Okay, it's
Yeah.
okay. I will retrieve it back. I will check it back in the YouTube because I'm missing overlook so many things. So let me give me some time to check it back inside my Google Drive and see everything that I can share to you later on.
Okay, sir.
Okay, but for this one, it's important. I should record it and share to you because it is related to your assignment, which is chapter 6.
Okay, sir.
Okay, so far I done recording. Okay, good. Okay, we are focusing on chapter 6, which is capital budgeting. But before that, overall, we will have like 8 to 9 chapters. Yeah, I think 9 chapters. So we still have another 2 or 3 chapters to go, yeah, before we end up the corporate finance module. Okay, this is the crucial part. Yeah. This is the crucial part because you see the word capital budgeting means that the word capital itself, which refers to the expenditure. That means the funding that needed to expand the companies in terms of expanding their assets. Yeah. Okay, so why capital budgeting is important? Because we look at that this one. Okay, the word capital generally refers to the resources that one can use to enhance future wealth. Okay, it can be monetary resources, it can be non-monetary resources. Okay, but usually the capital needed by the company is mostly in terms of monetary, which is funding. Okay, so this is one of the main resources that requires the company to initiate some kind like of expenditure or expand their businesses. And then the word budget means that refers to some form of plan, in this case, a specific financial plan. Okay, the word budget, it refers to the portion, proportion, the money that available, it will allocate into some financial element like expenses or expenditures, investments, and so on. That is a budget. That means allocation. Okay, so therefore, if we combine this word capital budgeting, it refers to the process of financial planning involve funding to be invested in long-term capital expenditure. Most of these funds are invested in fixed asset. Therefore, it is crucial for financial managers to effectively budget their capital for projects that will increase the firm's value. In other words, capital budgeting, which is fundings required to commence the project. Okay, funding that requires to commence a project. Okay, if the companies wants to initiate a project, one of the important resources that they need is a monetary resources. Okay, I will explain. I will give you the details on it later. Okay, so notable examples of projects. Okay, because so many different companies with different business types have different projects. Yeah, for example, construction company. Okay, construction company usually their project is on property, such as building houses and apartments, or maybe the transport companies such as construction, highways and motorways project. Okay, the third one, factory. Okay, in terms of factory construction and machinery purchase. So this is their project. Laboratory and agriculture department development in terms of science, laboratory research and development company. And the last one, such as sports, entertainment, community, and etc. Okay, so why I've come up with this project? It is because to initiate a project, they required financing. Okay, so in order for them to require financing, of course, they need to look of the for the sources of funding. Yeah, which is I already mentioned to you that there are two sources of funding, which is in terms of debt and equities. Okay, so with the funding that they have, they need to allocate and project it properly and properly allocated in order to get the desirable return. Because if the project is over cost, if the project is over value, which is the expenditure is more than revenue, okay, the project will be fail, definitely. Yeah. So hence we look at the nature and characteristic of the project. Okay, you need to understand the basic of the project as far as financial is concerned. Okay, so let's have a look at the first rule of thumb here. There is a large cash outflow today, while the cash inflows or benefit are spread out over a number of years in the future. This is because the machines or project generally last for the number of years. Okay, listen very carefully here. Okay, the reason why the first basis here, which is okay. Let me give you a technical example. Okay, if you know the Sunway Lagoon, okay, the Sunway Lagoon is a water theme park. Okay, in the initial years before during the construction, yeah, they invested a lot of millions, yeah, in order to construct a Sunway Lagoon. Okay, if they're investing means that there is a cash outflow. That means money is going out because they need to expand in order for them to construct a Sunway Lagoon. Okay, that is a part which is cash outflow, right? Because they are investing, okay, and then constructing a Sunway Lagoon. And then, yeah, after that, once a Sunway Lagoon is already built and constructed, and then can operate as usual. So therefore, yeah, the tourists, yeah, the consumer, the people everywhere around the world will come and then pay the tickets, yeah, and then buy some foods or everything, yeah, okay. So once they enter the Sunway Lagoon, they need to pay a ticket. They need to spend some money, yeah, which is a revenue for the Sunway Lagoon itself. Okay, let's say one ticket for Sunway Lagoon is, let's say, 60 ringgit or $60, for example. Okay, there is a one customer. Imagine there is a 1,000 customer. They can get 60,000 in a day. Yeah. So therefore, yeah, cash inflows, yeah, because of due to the ticket sales and then the food sales, yeah, any merchandise sales and so on, the revenue will be generated, okay, years by years. First year, second year, third year, fourth year, fifth year, and so on. Okay, that is how project works. Okay, same goes to the property projects. Property projects, yeah, the property or the construction company will spend 1 million to initiate the project of constructing a house or properties. Once they are successfully built the house, they can sell the house to the purchaser, yeah, purchaser or which is buyer. Okay, so the buyer will pay, some kind of money, yeah, in terms of down payment, borrow from bank and so on. Okay, so therefore, yeah, the property sales has been successfully conducted, and then the money will be inflow to the company itself. So that is how a project works. Yeah, they investing first, and then they will collect the money later. Okay, that is how project works. Okay, in the question also, they will illustrate to you on how the nature of the project works. Yeah. Okay, the second rule is the project are very costly. You see here the words very costly. That means usually the projects are very expensive. It's not like chap ayam, or it's not something like that. Very costly, which is it is involve millions and millions. Okay, can you imagine some lagoon projects involve a multi-million project? Okay, and then KLCC itself, yeah, multi-million project, yeah, and then monorails, yeah, and then labs, stadiums. Okay, so this one, yeah, the projects involved are very costly because it involve huge amount of monies to be spent. Okay, because they need to spend in terms of raw materials and labor costs. Raw materials such as cements, sand, bricks, yeah, and then steel, yeah, everything that associated with the property itself. Okay, and then labor cost, that means cost they need to pay to the workers. It will vary based on the economic situation. Okay, during recession, yeah, probably the labor cost will be expensive, yeah, for example. Okay, and then probably in terms of a good economic condition, the labor cost might be stable and might be cheaper than that. Okay, or it depends also on there are so many key economy indicators you can have a look there, which is vary the raw materials prices. Okay. And the third one, the nature of cash flow makes the whole process of analyzing capitals project very critical. Okay, therefore, yeah, you as a financial manager need to ensure that the project that you decided to initiate must have desirable return. Because if project's cash outflow is more than cash inflow, the project is considered as fail. In other words, if expenses is more than revenue, the project is considered as negative. Okay, negative cash flow because there is more cash outflow rather than cash inflow. Can you imagine? The property companies build 10 houses, okay, with the amount of millions, but there is no buyer. Okay, there is no one wants to buy the house, okay, because of the certain negative factors and so on. So therefore, the company will be shut down or consider as making losses because they cannot find a potential revenue. That is a problem with the project. You can see nowadays, outside, when you go outside, you can see a abandoned project, incompleted project. That is because of the cash flow issues. Yeah. Okay, especially during the pandemic, we've seen many cases, whereby the companies are forced being shut down because of negative cash flow. Yeah, the project commence and then somehow they cannot find the buyer. They cannot find the potential revenue. So that is an issue. Okay, let's have a look at the forms of capital budgeting and project evaluation. If you have any question, you can leave in the chat box and also you can interrupt me. No problem. Yeah, I am open to the questions. Okay, so the first one is independent project. Okay, why independent project? These are the project which is not related to one another. Okay, the acceptance or rejection of one project does not affect the decision of another project. Example, we have two projects, which is construction toll at Sungai Besi and the toll construction at Federal Highway. Because these are not related because these two, Sungai Besi and Federal Highway, is quite far away. Okay, so therefore, if you accept one of the project, it does not affect another project. Okay, let's say you want to proceed with Sungai Besi first, that's fine. Okay, and you reject the Federal Highway, you can construct the Federal Highway toll later on. Okay, so that is independent project. That means it is not related to one another. Okay, the second one, it is opposite one, which is dependence project. Yeah, dependent projects are dependent on one another. This means the implementation of one project may have an impact or relationship. For example, if the firm is planning to build a new factory in a low location, then it must also consider necessary infrastructure that must be available to support the factory's operations, such as proper road leading and also proper parking facilities. Apologies. All right. What I'm saying here is dependent project is if you if you initiate one project, there must be a sub project, that need to be initiated as well. Okay, if you construct a project, a factory project, there is not purely on factory only, right? Inside the factory, you need to install another thing, which is machinery, equipments, okay, and then the layouts, and then the infrastructure around the factories. So there are multi sub project that relate to the one big project. That is a dependent project. That means one project is related to another project. It can be a direct dependent, and it can be a indirect dependent. Yeah, but somehow this one project is related to another project. Okay, another example, the project of construction of a house. Of course, there must be a project of road construction, utility construction, sewerage construction. Yeah, so these are the dependence project, which is one project can have impact with another projects. Yeah, that is a dependent one. And the last one, which is mutually exclusive project. Okay, this is mostly practiced by companies around the world. These are the dependent projects where the acceptance of one project means that the automatic rejection of another. Okay, example. If the project to come up with a new product, either coffee flavor or chocolate flavor, if the company decide to choose chocolate, automatically coffee will be rejected. That means they have two projects, you can only accept one, automatically you cannot accept another one. Okay, you need to make a decision. This the reason why mutually exclusive is crucial, because as a financial manager, you need to make a critical decision related to the project. Because if you wrongly evaluated, wrongly analyzed, you make a wrong decision, definitely you make a company lossable. Okay, so need to evaluate and critically. Okay, critically thinking about the best one. Yeah, so that is a mutually exclusive project. Huh? All right. I'm open to question. Any questions so far? Yeah. Any question? Anything clear regarding the projects ones? In the latter part, the calculation part. Okay, I'm hope that you can understand on how capital budgeting works. Okay. How about the others? Like Ainon, like Ahmad, Alia, Vinod, maybe. Yeah. Halis, maybe. Fariha. Okay. Everything is fine, eh? Okay. All right. Do you want to take a break or do you want me to continue? Let me know. Take a short break or want to continue? Break. Okay. How about the others? Need a response, because otherwise I cannot make decision. I want to ease you all a little bit. Okay, break, eh? Okay, if break, we need a short break of 3 minutes. Yeah. Okay. And then we will continue. Okay, you can have some drinks or you can have some toilet breaks. Yeah. Okay, just is a little bit. Wait, I said 3 minutes. Okay, 3 minutes. Because we need just a short break only. Because I think if everything is goes well, we can finish quite early. Okay, 3 minutes. Okay, let's continue with the next part. Okay. Krishma is like desperate. Break, sir, please. Okay. But never mind. It's okay. Okay. 6.5. Yeah. This is a calculation part because okay, please take note, yeah, and take it seriously because the coursework is related to this part. Okay. Capital budgeting analysis techniques. Yeah. Later on I will explain to you, but you need to understand on how calculation works. Yeah. Okay. We have usually three calculations here required to analyze capital budgeting. Okay. So the first one, which is payback period. What is payback period? This method, as the name suggests, measures the time in years and months it takes to recover back the firm's initial investment or cash outlay in the project. In other words, yeah, how long that company can get back their money. Okay, I repeat again. Payback period means that how long the company can get back their money invested in the project. Okay, so if you're saying about how long, that means it refers to the time, isn't it? So, the sooner the better. Yeah, the rule of thumb is simple. The earlier they can get every money that they're spending, yeah, the better it will be. Okay. All right. So, payback period, the formula will be year full recovery plus investment minus A divided by B. Okay, which is IO. IO actually this one, investment. Okay, investment is similar with IO, initial outlay. That means initial investment that they made. Because they need to construct a project and then they need to invest first. And then A, cumulative cash flow during year full recovery, and B, annual cash flow after year full recovery. But before you calculate using this formula, you need to construct a table later on. I will show you in the examples. Yeah. Okay. So the second part, which is net present value. Okay. Basically, the word net present value as a difference between present value of cash flow and the present value of cash outflows. Simply, it as follows. In other words, yeah, present value means that what will be the realized profit, yeah, the realized profit that they will get after the project have their own projection. Okay, because year 1, year 2, year 3, and year 4 means that there is a future revenue projection, so we need to discount it back, yeah, to calculate the realized profit. Okay, considering these future projects. Okay, future revenues for the project. Okay, and then you need if you notice here, why year 0 is a negative. Yeah, there is a bracket here, means that negative, because negative represent cash outflow. Remember, the basic principle or rule of thumb of the project is spend now and then get the money later. Okay, invest now and then you get the money later. Money outflow first and then money inflow later. And then PVIF, we already mentioned many times in terms of chapter 2 and 3, bond and common stock. Here we have the table and the appendix. Okay. And then the present value, that means column number 2 multiplied by column number 3. Yeah. Cash flow multiplied by PVIF. And then you get a sum of net present value. Okay, this will be done by the table. The table makes it very easy for you to work with, yeah, and get the desirable answer. Okay, the third part, yeah, the third calculation will be accounting rate of return. Another technique that can use to measure the project viability. The larger the ROR, the higher the project relative return to its cost. Okay, so basically the formula will be average cash inflow divided by cash outflows multiplied by 100. Okay, the word average means that, okay, total cash inflows divided by number of years. Okay, for example, if the project is 5 years, total 5 years revenue divided into 5, make it average. Okay, and then cash outflow is only one, which is at the year 0. Yeah. So decision to choose the best project, okay, based on the fastest payback period, highest NPV, and highest ARO. Okay, if you look at this example, usually the question that come out is they given you two projects, okay, which is project left side one, your star, and the project the right side one, which is diamond. Your task is to analyze these two and choose the best. Whether are you gonna choose this project, kiosk star, or are you gonna choose kiosk diamond? How to choose is based on your calculation. And then of course, yeah, they given you your investment initial outlay, and then they given to you cost of capital, which is related to your K, which is for PVIF calculations. And so these are the questions that they are asking. Okay. So these are the example. Yeah. I will demo to you. Don't worry. Yeah. This one you can refer back to this slide for you to use as a reference. Okay. No worry. Okay. Here should be selected and done. Okay. Let me demo to you on how to answer this kind of question. Similar with the example. Okay, let's have a look at, I think question number 4 lah. It's the best thing. Okay, let's have a look at question number 4, shall we? Okay. Let me zoom a little bit so you can have a closer look. Okay, this question 4 eh. Okay, this question 4. Alright, but before that, we have a zoom in zone. Okay, wait wait a second. Never mind. Let's see. Okay, have a look at this question 4 ya. Okay, Cahaya Mentari Berhad is in the process of deciding to purchase a new machine. The cost of capital is 12%. The following are expected cash flow for each machine. Okay, so they given you 5 years, year 0, year 1, year 2, year 3, year 4, and year 5. And this machine A have respective cash flow, and machine B have also respective cash flow. But you need to alert that year 0, you always make it negative. Okay, I repeat again. For year 0, you must make it negative, even though the question looks is positive. Okay, why? Because remember, rule of thumb, year 0, it is a cash outflow. That means money out. So that's why money out, you need to make it as a negative. The rest, year 1, year 2, year 3, year 4, and year 5, these are the cash inflows. That means the revenue, projected revenue generated, yeah, for the respective years. Okay, so the first question is calculate payback period for machine A and machine B. Okay, so let me show you the calculation. Wait now. Okay, so question 4 eh. Question 4. Payback period for purpose. If they're same, both project means that you need to calculate machine A and machine B. Yeah. So PP for machine A. Okay. So you need to construct a table first. Eh? Okay. Give me some time to construct the table. year cash flow cumulative CF. Cumulative cash flow. Alright. For payback period, okay, start with 1, Okay, because year 0 will be doing for some matching later on, Okay, for machine A, cash flow. How do you want to get cash flow from machine A? Look back at the question and year 1, just copy and paste here. Okay, year 1 for machine A, 40,000. Year 2, 35,000. Year 3, 30,000. Year 4, 25,000. And the last one, year 5 will be 20,000. Okay. To calculate accumulative, cumulative means that you accumulate year by year. Okay. Usually the first year, cumulative is same as the year 1 cash flow, which is 0 plus 40,000, which is 40,000. But the second one, okay, 40,000 you need to plus with 35,000 because you need to accumulate 40 plus 30, 35. So if you press the calculator, 40,000 plus with 35,000, you will get 75,000. For the third year, you need to accumulate, the second year, 75,000 plus with the cash flow from that year, 30,000, plus with 30,000. 105,000. For the fourth year, cumulative cash flow year 3 plus cash flow for the year 4, just plus 25,000, which is 130,000. And the last one, 130,000 plus with 20,000. I believe it will be 150,000. Okay, that is the first part. Okay, but you need to look back at this one, machine A. Machine A year 0 is 120,000. Okay, 120,000. Okay, just set in your mind 120,000. All right. Do you see anything that match with 120,000 here? No, right? But you need to put at the position whereby 120,000 is between which cumulative CF and which another cumulative CF. Okay, in this case, cumulative cash flow, 120,000 is somewhere between, let me no fill here. Okay, shape outline, it should be red. Somewhere between 105,000 and 130,000. Okay, let me do a text box and see. Is a text box. 120,000. Okay, it takes some time, No fill, no outline. Sorry. Okay, and then I insert shapes. And where is yeah, this one. Okay, you see, 120,000, which is initial investment or initial outlay, is somewhere between 105,000 and 130,000. Okay, it means the payback period, the money that the machine A can get back, the company can get back from machine A is between as fast as between year 3 and year 4. Okay, you see 120,000 is between this amount, these two amount. Okay, so inside this box, you just put it as A. Okay, A means that here, A. In the box at the top right side, cumulative, and then B is here. Okay, so inside the box. So that is how you do it. So therefore, PP is payback period is equal to, let me insert the formula. Okay, year full recovery plus with A divided by B. Okay, so this is the formula. Alright, so the full recovery is okay. Remember, the in the box is between year 3 and year 4. So that means this is an interpolation whereby we need to find a precise figure between one to another. That means we are expecting that if year 3 and year 4 means that the answer might be 3 point something something something. So for year full recovery in the box, you take the earliest one. Okay, for, year 3 and year 4, you just take the earliest one, which is year 3, which is 3 years plus with, I should put the formula. Okay, equation, 3 years plus with. Okay, investment. This is the investment, this one, 120,000, year 0. Minus with A you already put here, which is A, 100, 105,000. Okay, divided by B. B is here, this one, 25,000. Okay, so by using calculator, you need to resolve this bracket first. 120,000 should be grouping. Okay, then most like it. Minus with 105,000 divided by 25,000 plus 3 years. So you can get 3.6 years. No need to find day, months or dates. No, just take decimal. That's enough. Okay, that means machine A can return back their payback period as fast as 3.6 years. Okay, that means the company can get back their money by 3.6 years if they choose machine A. So that is the first part. But remember, you need to calculate for both projects. That means two projects, which is machine A and machine B. Okay, let's speed up for machine B. Okay, using the same table and the same method, the difference is cash flow is different. Yeah, cash flow is different. Okay, so what you have, you need to same procedure, same procedure with machine A, but the difference is cash flow. Okay, let's have a look at machine B cash flow. Machine B cash flow, everything is 40,000. Everything is 40,000. Okay, for cumulative CF, 40,000. The second part, 40 plus 40. 40 plus 40 is 80. 80 plus 40 is 120. 120 plus 40, which is 160. And then 200,000. 160 plus. Okay. But somehow you find that this 120,000 is similar and match with cumulative CF. Technically, you don't have to calculate. If there is a same year, if there is a match, that means you don't have to calculate. But if you want to calculate, no problem. You will still get the same answer. So therefore, even though you use this formula, you still can get the same answer. So therefore, your PP is 3 years. Okay, I didn't calculate because, okay, as you can see here, this investment of 120,000 is matched with cumulative cash flow of 120,000 for at the year 3. So that means the answer is 3 years. But if you want to still calculate, no problem. Yeah, whether you put at year 2 between year 2 and year 3 or year 3 to year 4, you will still get the same answer. Okay, this is the case of your initial investment is matching with cumulative CF. But this one is not matched. So if not matched, definitely you need to calculate the payback period. Okay, so that is done with the first part. Okay, open to question. Any question related to payback period so far? Yeah, everything is okay. Just need a response. Can you understand the calculation?
Yes, sir.
Okay, everything is okay.
Yes.
Ahmad, okay, Ahmad?
Yes, sir.
Okay, good, nice. All right, the second part, the second part is this one: estimate net present value for each machine. Okay, so net present value. Right, project A. So not project A, machine A, sorry. NPV for machine A. Okay, to calculate net present value, you need to construct a table of 4 columns and the rows, it depends on the year. Okay, year, cash flow, and then PVIF, and then PV of cash flow. Okay, but this one, NPV, you need to start with the year 0. I will tell you why. I will tell you why later on. Another one, the last one. Because this one is until year 5, because until year 5, so need to do another one. Which sales at present. Year, cash flow. Alright, as far as cash flow is concerned, for machine A, just copy and paste. This one. Just copy and paste. But remember, year 0 must be negative because remember, I told you that year 0 is usually cash outflow. So, negative 120,000. Okay, and then 40, 35, 30. Just copy paste. 35,000. 30,000. 25,000. 20,000. Okay. And then PVIF. Okay. How do you want to know which percentage that you want to choose for your PVIF? Look at the question here. You see, the cost of capital is 12%. This one, 12%. So therefore, you will choose 12%. This is on how you choose the cost, the percentage here, cost of capital. Right. Remember, that I already show you many times on the PVIF and PVIFA things. You need to look at this appendix table. Okay. Appendix table. I open this one. Remember, you need to choose the right table because in appendix we have two, which is PVIF and PVIF FA. So since this capital budgeting is mostly goes to PVIF ones, okay, checks. Alright, for 12% and year 0. Okay, as you can see here, the period starts from 1. There is not start from 0. So that means there is no PVIF 12% and 0. Okay, that means you need to put that as dash. Don't put as 0. Why? Later on I will tell you why. You need to put dash. Dash means that the figure, the value is not available. The value is not available. Okay, but for first year, which is PVIF 12 and year 1. So that means you need to look at this one, 12% and 1. So 12% and 1, which is referring to this one, 0.8929. Okay, take the value and then transfer into the table. And then 12% and year 2. Okay, 12% and year 2, which is 0.7972. For the third year, 12% 3, which is 0.118. Year 4, just looking down there, 0.6355. And the last one, 12% 5, which is 0.5674. Okay. Next, will be the final part, the crucial part, PV of cash flow. To calculate that, column number 2 multiplied by column number 3 for each row. Alright, but for the first year, okay, the answer will be 120,000. Okay, why? Because this PVIF value is not available, not 0. Okay, if you put 0, that means 120,000 multiplied by 0, and then suddenly you can get 0. That is totally wrong. Why? Because I will question you where it goes. Where does 120,000 goes? Okay, because 120,000, because they don't have interest, because it evolves only at the year 0. There is no cost of capital or interest that counts for the cash flow itself. So the amount is maintained. That means no additional cost or no discount, no premium and so on. So the amount is maintained. Okay. But for the second part, 40,000 multiplied by 0.8929. 0.8929. Just take two decimal point if available. Okay, if not, just let it be 35,716. The third part, 35,000 multiplied by 0.7972, 27,902. Okay, and then year 3, multiply both 30,000 multiplied by 0.718, 21,354, 25,000 multiplied by 0.6355, 1588. Just round up, I don't mind about 50 cents and so on. 5588. And the last one, 20,000 multiplied by 0.5674. You get 11,348. Okay. Alright. To find net present value, the positive value you need to add everything except for this part, negative. Negative that you need to minus. Okay, which is 35,716 plus 27,902 plus 21,354 plus 15,888 plus 11,348 minus 120,000. You get negative 7,792. Okay, if negative means that there is not net present value anymore. It is net loss. Yeah, it is net loss. Okay, that means the project, occurs losses. Okay, because of the return that they get is negative. All right. So you need to understand. If you get positive value, yes, surely the project is profitable. Okay, but if you get negative one, means that the project is lost. Yeah. Okay, next part, net present value for machine B. Okay, let me speed up because I believe that you can understand how to calculate this. Okay, the same procedure. Okay,
Sir,
except that, yes,
actually it's positive.
Yeah, sir.
it's positive because I did this one.
Yeah,
16 plus 27902. Let me check. Minus. Negative.
because of sir add first and then minus it comes negative.
Okay, let me doing a reverse way. Negative 120,000. Okay, you see negative 120,000 plus 35.
Do we need to put negative, sir?
Negative, yes, because it is a cash outflow.
Okay.
Yes, you need to understand that. Okay, the negative sign means that there is money out. You cannot add up everything, cash inflow plus with cash outflow. Cannot, eh? All right.
Okay,
Cash
sir.
outflow means that okay. Thank you for the question. Okay, the cash out. You need to understand that the cash flow means that the money goes out from the company. That means the company spending the money to invest in a project. Okay. I give you a simple example. Okay, if you want to open a business, yeah, if you want to open a project to open a business, let's say you invested 10,000. Okay, if you invested 10,000, does it cash inflow or cash outflow? I'm asking you. Hello?
Outflow.
That one. Who's the one that asking me just now?
Cumulative.
Yes, sir.
Okay. I give you another example. Let's say if you open a business, if you have a project to open a business with the capital of 10,000. Okay. That means you are using for the capital, right? Does
Mhm.
10,000 is a cash out inflow or cash outflow?
Outflow.
Outflow, that means you spend your money, right? Okay,
Yes.
and then later month by month, year by year, you generated a profit because you are selling something, customer buy, customer loves your product and something. And then the sales that comes from your business, is it money cash inflow or cash outflow?
Inflow.
Inflow. So that means you need to um differentiate or find the margin between the revenue and expenses. Okay, as you can see here, these are the revenues. Okay, these are the revenues, which is money in, and this one is an expenses, right? Isn't it?
Mm-hmm. Yeah.
So if this revenue is less than is less than expenses, what does that mean? Losses or profit?
Loss.
Losses. So this what I'm saying here is negative. That's why I get negative because okay, if you calculate this one, okay, let me illustrate to you logical thing about the figure. 35716 plus 27 okay. 35716 plus 27902 plus 21354 plus 15888 plus 11348. Okay, as you can see here, this one 112208. These are the total from year 1 until year 5, which is total revenue, right?
Yeah.
Okay, as you can see here, total expenditure is 120,000. So which one is more? Is it outflow or inflow?
Outflow.
Outflow. Okay, so if outflow is more than inflow, that means it's a negative, and which is losses. Okay, never mind. Let me calculate for you since you already understand. Okay, the same goes to machine B because they use a same cash flow. See, 120,000. This one 40,000. Okay, 40,000 straight away. Okay, you don't have to worry about the next PVIF for machine B because they use the same rate. If they use the same rate, just copy and paste only. That's it. The same rate. Okay, usually the question uses the same rate. So therefore, you don't have to worry about finding it again and then you can transfer. Okay, let me calculate for you. Oh, sorry, I mistakenly calculate. Okay, 4,8929 35716. 40,000 multiplied by 0.7972 31888. 40,000 multiplied by 0.7118 28472. And then 40,000 plus with multiply with 0.6355 25420. Okay. And the last one 40,000 multiplied by 0.5674 22696. Okay, let's demonstrate. 35716 plus 31888 plus 28472 plus 25420 plus 22696 minus 120,000. Okay, 24,192. Okay, you see the differences between machine B and machine A? For those who are asking me just now.
Yes, sir.
You see, this is profit, right?
Yeah.
Profit because this total revenue is more than total expenditure. So as you can see. Okay. But logically, which one will you choose? Is it you choose machine A or machine B based on the calculation?
Machine B.
Machine B. Okay, because the machine B brings the profit. Yeah, rather than machine A. Okay, so okay, thank you for the question, and I hope that clears. All right.
Yeah.
Okay. Next, I will speed up a little bit. So the third question, which is average rate of return. Of return. You can put a formula, one formula for all. Okay, so this one, average return, average cash inflow divided by investment. Okay. So for average rate of return, which is average cash inflow divided by investment multiplied by 100. Okay, you need to average the cash inflow because this is a 5-year cash flow. Then you need to average it. Okay, let's go on for machine A. AROR machine A. Machine A. Formula. Sorry. By the way, I'm using this insert formula, so you can put it in your assignment. You insert a formula makes you easier to do calculation, to key in the calculation part. Otherwise, you key in manually, that's quite difficult ones. Okay, right. Let's have a look at machine A. Machine A, cash inflow is from year 1 until year 5. That means there is a different cash flow, 40,000, 35,000, 30,000, 25,000, 20,000. What you have to do is you need to average this 5-year cash flow. Okay, so for machine A, 40,000 plus with 35,000 plus with 30,000 plus with 25,000 plus with 20,000 divided by 5. Why 5? Because 5 figures, 5 years. 1, 2, 3, 4, 5. And then your investment is 120,000. This one you don't have to put negative. Yeah. By 100. Okay. So using your calculator, average first 40,000 plus 35,000 plus 30,000 plus 25,000 plus 20,000 divided by 5, which is 30,000. This one 30,000 divided by 120,000 multiplied by 100, which is in percentage 25%. Okay, that is a machine A. Okay, for machine B, using the same formula, but yeah, different cash flow. I just copy paste here. That's sorry. All right. So for this one, machine B, okay, if you want to show, never mind, because every year is 40. Yeah, I just show for your understanding. Yeah, which is 40,000 plus 40,000 plus 40,000, 40,000 and 40,000. Same, 120,000 divided by 100. So you press the calculator, you still get 40,000 because same amount, right? Okay, divided by 120,000. 33.33%. Okay, done. Alright, so you're done with AROR. Okay, the last part, the last part will be which machine should you choose and why. Okay, this is to test your analytical skill. Analytical skill means that you already perform the calculation and you need to comparing side by side and then you decide which one is the best. So that's why financial analyst is mostly done sort of thing. Okay, I forget this one. Yeah, there you can see. Alright. Analysis. Okay. For decision, Alright, first thing first, yeah, you need to do a table side by side. Okay. Machine A and machine B. Sorry, machine C. Okay, your PP, you can choose a short form, no problem. NPV, net present value, and then AROR. Okay, so all right, for machine A, just and machine B PP, you just take the answers. Yeah, machine A 3.6 years, machine B 3 years. Yeah, 3.6 years, 3 years. Okay. All right, for NPV, just take the answers for machine A 7792. And for machine B is 24192. For machines, for AROR for machine A 25% and machine B 33.33%. Okay, I go back to this slide because I want you to see on how to select this one. All right, for PP, you need to choose the shortest. Shortest means that the earliest PP, because remember, PP or payback period means that how long or how fast the company can get their money back, from the project. So since this is 3.6 years and this is 3 years, definitely you will choose this one, machine B. Okay, so I just put tick. Where is the tick ones? Okay, give me some time to find the symbol. Yeah, I think this one. Okay, see, 3 years. Okay, the second one, NPV, of course, you need to choose the profitable ones, this one. And AROR, choose the highest rated. Yeah. So therefore, yeah. So definitely, yeah, as you can see, machine B dominates machine A in terms of their capital budgeting with results. Eh. So therefore, yeah, the question is, what is the question? Which machine should you choose and why? I think it's not should you choose. I think Cahaya Mentari Berhad is. Cahaya Mentari Berhad. Because this is a company. Cahaya Mentari Berhad. Because it some kind like you are the consultant. Should choose E because A. Need to justify based on year on the comparison. Yeah. Okay, the first one. Fastest. Yeah. Payback period. Yes. You need to state the amount. Yeah. The amount or the figures. Yeah. And then highest NPV by RM 24192. Okay, and then highest ROR by 33.33%. Okay, so you done the analysis on machine A, you done the computation on machine A, you done the computation for machine B, and then you make a comparison, you make an analysis, and then you decide to choose project B. Okay, that is a capital budgeting is all. Wow. Okay. So done already with this set of question. Okay. Any question regarding payback period, net present value, AROR, and the decision? Any question? Very clear. Okay, nice. Mazwin, let know. Okay. Since okay, I let's have a look at another question. Okay. Say since the most of the question use the same procedure, but some of the question twist in the way that how question structured. Yeah. Okay, let's have a look at this one. Yeah. Okay, for question one should be no problem because for the year, okay, if I will share to you some of the tricks of the question. Now the question is made by myself. Okay, so let's have a look at question one. This question one should have no issues because year zero is already negative, so that should be no issues. You can go straight away. Okay, in terms of calculating your NPV and also your PP and so on so on. So that is a amount because it is clear that year zero is negative. Okay, but how about this one? Okay, as you can see for question 2, there is no year zero. Compared to this question have year zero. Okay, but do not panic. Yeah. If the question does not have year zero, you can still use year zero. How? Yeah, the question is how. You see here, which required an initial investment of 150,000. That means, in the table of, in the calculation table, you should put as year zero, and this one is 150,000. Okay, do not confuse. It's not 150,000 divided by 2. No. Yeah, 150,000 is allocated for both projects. That is how that is what the question means. Okay, it's not like 150,000 divided by 2 is wrong. Yeah, 150,000 for each project allocated. Okay, so if there is no year zero in the table, do not panic. Yeah, because the information is already given up there. Unless if if I don't given that information, yes, you can argue that the question is wrong or lack of information. Yeah, that is how question 2 works. Yeah, cost of capital is 9% and so on. There should be no issues. Okay, question 3 also same thing. There is no year zero here. Therefore, the project requires an initial investment of 70,000, which is for project A, negative 70,000 for year zero, negative 70,000 for year zero project B. Yeah, same thing. Okay, do not panic if there is no year zero. Question 4, even though there is a they put here as a positive, but do not put as a positive. You should put as a negative symbol. Okay, this also same thing. No year zero, okay, but you need to put that as a year zero, negative 180,000 for project X and negative 100,000 for year zero project Y. Okay, that's all. Okay, same procedure, yeah. Okay, you can look at the example on the and also yeah the video recording for you to make the clear understanding. Okay. Any question? No. Should I proceed with the coursework briefing? Are you ready? Okay. Can I proceed? Alia, can I proceed? Ainun, Ahmed.
Sure, sir.
Okay, nice. All right. So do not worry. This not that it's not that tough. It's not that tough. I made this module quite convenient for you to make sure that you get the basic understanding. Even though the name of corporate finance should be might be intimidating, but yeah, there is not the hard thing if you follow the right technique. Okay. You still can ask me later on if you struggle with the coursework. No problem. But don't say that you don't know nothing about it. But it's okay. You can still discuss. All right. This is an individual work. Yeah, individual work. So I'm expecting that there should be a different answers. Yeah. Okay. All right. Procedure. Yeah. Answer all question. Okay. And the deadline will be I believe this one it didn't take long. I believe you can submit on I think 21st should be okay lah. 21st January 2021. Yeah. Actually, you can settle this within 2 or 3 days only, but maybe you have some other works to do, so I can extend the submission and so on. Yeah, but as long as you need to complete it. Yeah. Okay, so procedure, answer all question. Okay, please listen carefully because if you did not follow this one carefully, did not listen carefully, you might end up misunderstanding. Yeah. Okay, Moonshine Corporation Limited is planning to venture into a new project. Okay, and it is currently gauging the viability and profitability of 5 mutually exclusive projects. Provided below is the after-tax cash flow for both system. Okay, so they provide to you 5 information here. Project A, Project B, Project C, Project D, and Project E. Alright, so before you answering question A, B, C, and D, you need to do an individual decision. Okay, that means you need to choose. Yeah, you need to make a decision first. Yeah, before you calculate A, B, C, and D. The first decision that you need to make is choose any 2 from 5 projects to be evaluated. So A, B, C, D, E, you need to choose any 2. Yeah, doesn't matter. Yeah, nothing. Everything is equally difficult. Not equally difficult. I mean same difficulty level. You can choose B and C or A and D or A and E or B and D. The sky is limit. The sky is limit. So you can choose either one, either 2 projects, either 2 projects that you feel that you want to work with. Yeah. Okay. That is choosing 2 from 5 projects to be evaluated. And then after that, once you choose the 2 projects, you need to determine the same expected return for 2 projects. Okay, choose any rate between 8% to 14%. You can choose 8%, you can choose 9%, 10%, 11, 12, 13, 14. Okay, choose one rate. Yeah, 8, 9, 10, 11, 12, 13, 14. Okay, so I repeat again. Choose 2 projects. Okay, and then choose any rate between 8% to 14%. That doesn't regardless of any rate between that. Okay, so later on, yeah, if you already choose 2 projects and then you choose one of these rates 8 to 14, let us know in the WhatsApp group so other friends did not choose the same thing. Okay, you know what I mean, right? You need to declare first. Okay, we'll do by list. We do by list which project that you want to choose, and then which rate that you want to choose to avoid a collision. Yeah, to avoid a collision or avoid that each individual might do the same thing, because that's why I'm open an option to you. The process, the calculation process and procedure is same. The difference is the figure. So that is already given the clue. So once you choose two projects and then you choose one rate, so you need to calculate A, B, C, and D, which one that you feel the best. That's it. That's it. Yeah. Okay, 20 marks. Yeah. So this 20 marks represent 20%. So therefore, yeah, if you are doing the right calculation, okay, and then you do the right thing, and then you choose the right projects, yes, there will be possibility of you to get a full marks. Okay. All right. So that's how you should do. Yeah. Okay. Don't forget to declare in a group, WhatsApp group, that's the project that you choose, two projects, and then the rate that you want to choose. Yeah, I will come up with the list later on. Yeah. Okay, so that's it. That's all. Yeah. Okay. Don't forget to have a cover page and then just put the answers. Yeah. Show your workings. Definitely you need to show your workings. Remember, okay, if you want to insert the formula, just click insert and then click equation, so you can adjust and something like that. Yeah. Okay. Any question? Any question regarding this one? Okay, as far as PVIF table and PVIFA table is concerned, this doesn't have 11, 13, 14. I will come up with the new set of tables that consists of 11%, 12%, 13%, 15%, and so on. So I will do it by this evening. I guess I will update to you with the new set of table. Okay, word length. I don't care about the word length. There is a calculation. So word length is not an issue. You don't have to do introduction. You don't have to do. This is straight calculation. Yeah. Okay. As long as the answer is there. Yeah, I know they show the word length, but just ignore it. Okay. Because there is. Yeah, I know. Thank you for that. Don't have to. Just ignore this one. I know that you're asking this one, right? Word length. Should not exist. Okay, this is a general rule. General. Actually, this is a general rule, but this general rule is applicable for case studies, and then applicable for written assignment, and then applicable for writing. This is not research writing. Mini research writing and so on. But this one is a calculation, so that is not applicable for that. Ile? Okay. All right. Okay, so do not worry about the word length, because the word length is just a general rule. Is specifically is for report writing, research writing, case study, and so on. But this one is a calculation. Yeah. Okay. All right. Just to check, and any one of you is not in the WhatsApp group, doesn't have a WhatsApp group, please let me know, because I'm not sure whether all of you inside the WhatsApp group or not. Please declare, because I'm not sure that is everybody in this group or not. Otherwise, you might feel left behind. Yeah. Everybody is the WhatsApp group, right? Okay. Since there is no response, I guess that everybody is already in the WhatsApp group. Okay. All right. When is the midterm? Okay. Let me check the calendar. All right. Okay, do you agree that I will conducting the midterm? Okay, I give you choosing. Do you want to do on 7 or do you want to do on 14? Yeah, I'm following the majority decision. Do you want to do on 7 January or 14? Okay. You choose. Yeah, the question is there already. Okay. Okay. I know that one, because of course you want to choose the latest one. How about the others? 14, 14, 14.
Because we have a midterm for advanced financial reporting.
Okay. Fair enough. How about the others? Kidir? Ahmed, how about you? 14. Okay. Krik, krik. Okay, 14. Okay, majority is gone for 14. Okay, so I don't mind. If you want to do on 14, that's okay with that. Okay, let me brief to you things about the midterm, yeah, midterm 14. Okay, so your midterm 14 January. Okay, so the time, the time. Okay, the time is from 11 a.m. Okay, and then submit to Turnitin before 5 p.m. Okay, all right. Okay, 11 a.m. on the same day, 11 a.m. and then submit to Turnitin before 5 p.m. Yeah, okay, on the same day. All right. And then I will also brief to you on the question meter on how to answer in the document and then to submit to Turnitin. That one I will inform you later. Okay. As far as question is concerned, okay, we have section A. Okay, and then section A, which is 10 MCQ, yeah, multiple choice question, and then section B, which is calculation, okay, calculations, 2 questions, answer 1. Okay, and then the topic that will come out is 5 topics. Sorry, 4 topics, I think. Okay, so the topics that gonna come out will be, okay, the chapter 1, introduction, chapter 2, bonds valuation, okay, chapter 3, stock valuation, and then chapter 4, and chapter 5 is leverage. Okay. From chapter 2, 3, 4, and 5, okay, especially in section B, calculation. And for chapter 1, mostly on theory part. Yeah, that one is so-called at MCQ questions. Yeah. Okay. But only short calculation, not long. Yeah. Cost of capital, or so-called SWACC. Yeah, weighted average cost of capital. All right. So the details, further details I will explain later. The study question is got answer. No, but you can let me know in the WhatsApp group which question that you answered, and I will do some checking. I think I will give you the maybe the final answer, and maybe you can give me the documents, Elaine, so I can check, and if that is okay, good, the answer is nice, correct, and then maybe you can share with the others. Is it okay if you can share with the others? Yeah, nothing wrong if you share the knowledge, right? Okay, Sam. Okay, Elaine, do not forget to give me the documents that you put the answer, so I will check, and then everything is okay. Then we can distribute, distribute and publish to everybody. Yeah. Okay. I give you the this week attendance is a free attendance for this week because this is a gift, New Year's gift from me. Yeah, New Year's gift. Okay. I already told earlier that there is a free attendance for today because this is a new gift. Sorry, New Year's gift. From myself. Yeah. All right. You got everything. Yeah. You got the attendance gift, and then also lecture chapter 6, the assignments, and then the midterm briefing. So I hope that everything will be smooth sailing. All right. Any issue, please let me know in the group. Okay, and then anything else? Please remind me if I forget something. I'm a human. Yeah, I'm a human. That's normal.
Just recorded time.
That evening. Yeah, this evening. Please remind me in the group. Yeah, otherwise I'm forget. Yeah.
Okay, so can.
Okay, I stop the recording.